My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to help you make money. My job is not just to entertain, but to educate and teach. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Hope is not a strategy. Too bad, because I'm seeing a lot of hope right now. I always applaud optimism because I bought my first stock when the Dow Jones average was about 34,000 points below where it is now. But I recognize there are times when hope is all you have, and hope can be a pretty thin reed. Of course, just because I say hope is not a strategy, I'm not telling you to abandon all positivity, including on a day like today, where the averages started strong and then rolled over. Dow ultimately dipping 88 points, S&P declining 0.34%, NASDAQ, which was soaring at the opening, finished down 0.3%. In fact, I think you can do very well right now in a balanced portfolio that also has a lot of cash on the sidelines. You want to be ready for the moment when things actually get better. It's just that there's so much uncertainty, you got to be a little more cautious than we might like, at least in a number of key sectors. Allow me to explain. First, I like to buy whenever I have some visibility into something good that might happen in the future. But I don't want to foment false positivity. So let's talk about what happened today. The most salient item, the consumer price index came in at 8.5%. Now, that's the highest reading in more than 40 years, and it's the worst number you could possibly have. I immediately tried to pick it apart. Why? I was looking for any signs that it could be the last horrible number, that inflation might be peaking, meaning that these would be, so much so, the bad numbers that we've been waiting for, so we can start buying. The only thing I found was the possibility that used cars, which are part of this index, might be turning down. We know that because CarMax, a terrific used car chain, reported some terrible numbers this very morning, with same-store sales down 6.5%, when Wall Street expected they'd be roughly flat. Why? Why were they down? Well, the average used car rose 40% in price year over year, or $8,300. Let's call that highway robbery. How can something go up that much and not crush the confidence of the buyer? The answer, it can't. You know, we call it in fancy economic classes what's known as demand destruction. And we're seeing demand destruction right now, right here in used cars. Now, how can these price increases be so crazy? It's simple. Because the automakers don't have enough semiconductors to ramp up the production of new cars. That's throwing off pricing for the entire industry. So you have to ask, what can bring that down? Well, you need more microchips. You look at many of the semiconductor stocks, and they've been clubbed. Why? Because they aren't making the right kinds of chips. Historically, the profit margins of the basic chips the automakers need just aren't great enough for the really fabulous chip makers to pivot and manufacture them aggressively. Very different kind of chip. Shouldn't amalgamate. They're not all the same. Now, our country's finally making strides in building new factories. It could help, but it's years and years and years away before those factories are ready. How did we end up with this chip shortage? For years, American companies have tried to have very little capital tied up in semiconductors or even any components in general. We thought the real money was in designing chips, not manufacturing them. We've now been in this jam for 2 years, and we won't get out of it until later this year at the earliest. That means the used car prices will likely stay elevated unless we get more demand destruction. Either way, it's bad news for the economy. So there was nothing there for me. Now, it might be natural to think that something has to stop going higher in price. But when I look at the two most visible things we purchase, food at the store and gas at the pump, nothing good happening. Food's a fungible item, trades worldwide. One of the things you want going for you if you're in the business of buying food is a bread basket, or to be more specific, the bread basket of the world, Ukraine. Thanks to the Russian invasion, something like 13% of all the calories we produce in the entire world could be in jeopardy. Russia's unprovoked act of aggression has taken Ukraine off the grid. And the sanctions on Russia have also taken Russian crops off the international market. There'll be no help from Eastern Europe to get food prices down. And the war's had a similar impact on oil because Russia's a giant producer, and now all sorts of countries are increasingly wary of buying their fossil fuels. Oil at $100, which is where it was today, has more to do with a lack of supply than strong demand when you think that China's basically shut down for the duration. Of course, it goes beyond commodities. As Gary Friedman, the straight-shooting CEO of RH, formerly Restoration Hardware, pointed out in his latest conference call, the psyche of the consumer has taken a huge hit from all this turmoil. Again, being hurt at the register is nothing like the kind of humanitarian disaster the people of Ukraine are suffering through, and I don't mean to equate that. But this is a stock market show, and the market cares about damage to our economy. I'm not being heartless. I'm just trying to help you make some money here. Joe, I'm actually bullish on the American consumer overall, like Matt Boss, the retail analyst from J.P. Morgan, was on last night. But on any given day, I say, come on. I mean, you don't want to plunge in on a day when inflation is simply out of control and mortgage rates are still climbing and oil's back at 100. Oh, and let's deal with the elephant in the room. No, let's deal with at least one of the bigger elephants in the room, China. You often hear from our experts that the Chinese government is full of geniuses. You'd think the Communist Party can do no wrong, right? At least in a tactical sense. Obviously, no one's denying they do a lot wrong in a moral sense. Yet now the People's Republic of China is going all in on a policy that's been repudiated by the rest of the world, a lockdown for COVID. The whole country's basically quarantined, including the places that make so many cheap goods that the rest of the world relies on. From the looks of things now, many of our manufacturers probably wish they had an ABC or any place but China policy when it comes to manufacturing. You know what's the craziest part? China's got an almost 90% vaccination rate. Should be fine, right? Problem is the government refused to use Western mRNA vaccines like the ones from Pfizer or Moderna, which is don't forget, Pfizer, BioNTech in Germany. I mean, so it's not really just the United States. Instead, China went with its own homegrown vaccines that have much lower efficacy. In other words, they'd rather lock down their entire country than use our vaccines. I hesitate what to call that, so I'll use my kind of benign term, suboptimal. I think that our tech companies will figure out other places to do their manufacturing. See, at this point, they have to. They can no longer afford to be hostage to a country once thought to be so business-friendly that's willing to shut down. Why? Because of national pride. But that'll take a long time to wean yourself out of China. And it's not something you can include in your calculus of whether to buy tech stocks. Now, even with all these negatives, there are still tons of good things that could happen. The war could end in Ukraine. China could open for business. The new semiconductor foundries will eventually make the chips we need. The consumer's collective psyche can change. The problem I have right now, though, is the problem that grips a market that opens much higher on a not as hot feared CPI, and yet then goes right back down because there are too many quandaries to call a top in the CPI. Especially, it doesn't do any good to think about tech. That's what's being hurt the worst. Bottom line, when there are fewer problems, you're leaving the realm of hope, and headed toward the realm of reasonable possibilities. We don't want to be in the hope. I love betting on reasonable possibilities. That's why we've got so much cash ready for the Travel Trust, so we can pounce when we start seeing them. But for now, all we've got is hope. And that's not enough of a game plan for this guy, and it shouldn't be enough for you. AJ in New York. AJ.
Hey, Jim, this is AJ Vallet from Long Island, New York.
How are you doing?
Roku down about 70% from its 52-week high. Do you believe it is still a strong stock to hold, or should I look to sell even though my average price is around $370?
I cannot believe that Roku doesn't make money. And we don't recommend stocks in the show that have that kind of revenue growth and don't make money. That's just wrong. Let's go to Don in Georgia, please. Don.
Hey, Jim.
Hey, Don.
Thanks for taking my call. My question's on Ford Motor Company. Big advocate of Ford, love their product. My son owns the Maverick, great little truck. Wanted to ask you what your thoughts are on the chip shortage and when we might start seeing another upward swing towards the 20s. I don't know if it might be this year, next year, or what your thoughts are.
Well, first, Don, we are kindred, my son, your son and me. I have the Maverick. I love it. I love it so much that my wife took it because she thinks it's fantastic. The problem is they can't make enough of them. Why can't they? Well, because they don't have enough chips. They also have very high commodity costs. That said, I think after a couple of months, I think they're finally getting their arms around us, but it may not help this quarter. Still, the stock is so cheap. We own it for the trust. We sold some higher. I still like it, though. We have a reasonable sized position. All right, now look, speaking of reasonable, I love betting on reasonable possibilities. But for now, all we've got is hope. And hope is not enough to put money to work with. On Mad Money Tonight, we're continuing our series on finding growth at a reasonable price and surveying the financials to see if any of the key players are worth eyeing. Then could high peak energy be a high point in this market? I'm taking a close look at the oil and gas stock. And tech stocks like Twilio have really fallen out of fashion in the Wall Street Fashion Show. But I'm seeing if this cloud stock could buck the trend with a whole new survey about what customers want. We're going to talk to the CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.